You don't invest with logic, you believe you do. And that belief is exactly what makes your financial behavior so dangerous. Because the moment you think you are being rational is usually the moment you stop questioning your decisions. Most people think their investment results are shaped by the market. They blame volatility, they blame timing, they blame bad luck. But something much more uncomfortable is happening beneath the surface. Two people can look at the same chart, the same data, the same opportunity, and make completely opposite decisions. One buys, one sells. Both believe they are right. Both believe they are being logical. But they're not operating on logic. They're reacting to something else, something faster, something invisible, something they rarely question. Emotion. Not the obvious kind, not panic, not excitement, something more subtle. Interpretation. Because you don't respond to money itself, you respond to what money represents to you. Security, status, fear, control. And those interpretations quietly shape every decision you make, long before logic ever gets involved. This is where the real pattern begins. Not in the market, not in your income, in your perception. Most people imagine decision-making as a sequence. First, they analyze. Then, they decide. Then, they act. But in reality, the order is reversed. First, you feel. Then, you decide. Then, you justify. And that last step, that's where the illusion of logic is created. You don't make rational decisions. You create rational explanations for emotional ones. That's why two investors can experience the same market and walk away with completely different results. Not because one had better information, but because one had a different emotional response. And here's the part most people never notice. These emotional responses don't feel like emotions. They feel like certainty. They feel like intuition. They feel like, this makes sense. So you trust them, you act on them, you repeat them. And over time, they become your pattern. A pattern that feels logical, but produces inconsistent financial outcomes. You see this most clearly in moments of uncertainty. When the market drops, logic would suggest one thing: stay consistent, stick to your strategy, think long-term. But that's not what most people do. They hesitate, they wait, they second-guess, and eventually, they exit. Not because they analyze the situation, but because the discomfort became too strong, and relief felt more important than growth. Then the market recovers. Prices rise again, and suddenly the same person who sold out of fear feels confident again. Now it feels safe. Now it feels like the right time. So they re-enter at a higher price, with less conviction, and they call it strategy. But it's not strategy, it's emotional sequencing. Fear, exit, relief, re-entry. And every time this loop repeats, something invisible happens. You don't just lose money, you lose alignment. Alignment between your actions and long-term growth. Because wealth is not built through isolated decisions, it's built through consistent behavior over time. And consistency is exactly what emotion disrupts. Not once, not dramatically, but quietly, repeatedly, over years. This is why many people can spend a decade investing and still feel like they're not making real progress. It's not because they're not trying. It's not because they lack information. It's because their behavior is unstable. And unstable behavior produces unstable results, even in a stable system. This is the hidden cost most people never calculate, not fees, not taxes, behavior. Because every time you act on emotion, you slightly distort your financial trajectory. And those distortions accumulate. A delayed entry here, an early exit there, a missed opportunity somewhere else. Individually, they seem small, almost irrelevant, but over 10 or 15 years, they compound in the opposite direction, not as growth, as erosion. And the most dangerous part, you don't notice it while it's happening, because each decision feels justified, each action feels reasonable, each moment feels like an exception, but it's not. It's a pattern that feels logical, because you're the one creating the explanation. And as long as that explanation makes sense to you, you never question the behavior behind it. You just repeat it, again and again and again, until one day You look back and realize something doesn't add up. You worked, you saved, you invested, you followed the rules, but the outcome doesn't reflect the effort, and the instinct is to look outward, to blame the system, the economy, the timing. But the real explanation is much closer, much more uncomfortable, much harder to accept, because it means the problem wasn't what you knew, it was how you behaved. And behavior is rarely as rational as we like to believe. If you look closely, this pattern doesn't just appear during extreme moments. It shows up in small, ordinary decisions, the kind you don't even register as important. That's what makes it so difficult to detect, because you're not reacting to dramatic events. You're reacting to subtle signals, a headline, a price movement, someone else's opinion, and each one slightly shifts how you feel. Not enough to alarm you, but enough to influence you. You don't notice the emotion, you only notice the conclusion. This seems like a good time to wait. This feels too risky right now. Maybe I should move my money somewhere safer. Those thoughts feel reasonable. They feel measured, they feel logical, but they are not coming from analysis. They are coming from discomfort. And discomfort has a very specific objective, to make you act in a way that reduces it, not in a way that maximizes your long-term results. This is where the financial consequence begins to take shape, not in one large mistake, but in a series of small deviations, each one slightly misaligned with what would have produced growth. Imagine two investors with the same income, the same access to information, and the same long-term goal. One follows a consistent strategy. The other adjusts constantly based on how things feel. At the beginning, their results look similar. There is no obvious difference, no visible gap. But time changes that, because consistency compounds. And inconsistency does something else. It fragments results. Every time you hesitate, you delay compounding. Every time you exit early, you interrupt. Yet every time you wait for certainty, you miss part of the curve. And these are not rare events, they happen repeatedly, quietly, without drawing attention. That's why the cost is invisible. You don't see what could have happened, you only see what did. And what did happen feels acceptable, because you can always justify it. You can say, I was being careful. I didn't want to take unnecessary risks. I was waiting for a better opportunity. All of those explanations sound responsible, but they hide something critical. They hide the fact that your behavior is reactive, not strategic, because strategy requires something most people underestimate: tolerance for discomfort, the ability to stay consistent when things feel uncertain, the ability to act without emotional confirmation, the ability to trust a system more than your current feelings. And that's exactly where most people fail. Not intellectually, emotionally. Because when uncertainty increases, the brain doesn't optimize for growth. It optimizes for safety. It prioritizes immediate relief over long-term outcomes. And that changes everything, because financial growth is not built in comfortable conditions. It's built in periods of ambiguity, periods where nothing feels certain, periods where the correct decision does not feel good. This is where the gap between logic and behavior becomes visible. You may understand compounding, you may understand long-term investing, you may even believe in it, but belief is not the same as execution. Execution requires consistency under pressure, and pressure is exactly what triggers emotional responses. This is why many people can explain good financial principles, but fail to apply them, not because they don't understand them, but because they don't follow them when it matters most. They follow how they feel. And feelings are unstable. They change with context. They change with noise. They change with short-term outcomes. So your behavior changes too. And when behavior changes, results become unpredictable. This is the real financial consequence of emotional decision-making. Not just lower returns, but unstable returns. Returns that don't reflect the system you intended to follow. Returns that are shaped by interruptions, hesitations, and reversals. Over a year, this might not seem significant. Over 5 years, it becomes noticeable. Over 10 or 15 years, it becomes decisive. Because while one investor allowed compounding to work uninterrupted, the other kept resetting the process. again, and again, and again. Each reset small enough to ignore, but large enough to matter. And this is where the illusion becomes dangerous, because the second investor still feels active, still feels responsible, still feels like they are making smart decisions. They are engaged, they are paying attention, they are reacting. But that activity is not producing better outcomes. It's producing friction. Friction against time, friction against compounding, friction against growth. And friction doesn't need to be dramatic to be destructive. It just needs to be consistent. That's what makes this pattern so expensive, not the intensity of the mistakes, the frequency. Because when a small behavioral error repeats hundreds of times, it stops being small, it becomes structural. And structural problems don't show up immediately. They reveal themselves slowly, in the form of missed growth, delayed progress, and a constant feeling that something isn't working. Even though everything seems correct on the surface, this is why many people reach a point where they start questioning the system itself. They begin to wonder if investing actually works, if long-term strategies are realistic, if consistency really pays off. But the system is not the issue, the pattern is, because the system assumes one thing, that behavior remains stable, and when that assumption breaks, the results no longer match the expectation, not because the system failed, but because the behavior feeding it was inconsistent. And inconsistency is rarely visible in the moment it happens. It only becomes clear when you step back and see the accumulation of decisions over time, decisions that felt logical, but were never truly aligned. At this point, most people start to assume the solution is simple. Control your emotions, be more disciplined, stick to the plan. But that assumption misses something critical. The problem is not that you feel emotions. The problem is that you don't recognize when they are shaping your decisions. Because emotional influence rarely feels like emotion. It feels like reasoning. It feels like clarity. It feels like this time is different. And that's what makes it so effective. You're not fighting panic. You're operating under a narrative that feels correct, and as long as that narrative makes sense, you won't question it. This is where the second layer of the pattern appears. Not just emotion influencing decisions, but emotion shaping perception. Because before you act, you interpret. You interpret information, you interpret risk, you interpret opportunity. And those interpretations are not neutral. They are filtered. Filtered through past experiences. Filtered through recent outcomes. Filtered through what you've been exposed to. If the market has been rising, opportunity feels obvious. If the market has been falling, risk feels dominant. Same environment, different perception, and perception determines behavior. This is why emotional investing is not random. It's structured. It follows predictable cycles, not based on logic, but based on how humans respond to uncertainty. There are three dominant emotional drivers that repeatedly shape financial decisions: fear, euphoria, and validation. Fear pushes you out of the market, not because the fundamentals changed, but because uncertainty becomes intolerable. Loss becomes more painful than potential gain. So you reduce exposure, you wait, you protect, and you call it prudence. But what you're actually doing is avoiding discomfort. Euphoria does the opposite. It pulls you into the market, not because the opportunity is new, but because the outcome now feels certain. Prices have risen, confidence increases, the environment feels safe, so you enter. Not early, but late, and you call it momentum. But what you're actually doing is chasing confirmation. Then comes validation, the most subtle of all. Because you don't just react to the market, you react to other people reacting to the market, opinions, trends, consensus. You look for signals that confirm your thinking, not because you lack intelligence, but because agreement reduces doubt, and doubt is uncomfortable. So you align, you follow, you adjust, and you call it awareness. But what you're actually doing, that is outsourcing conviction. These three forces don't act separately, they overlap, they reinforce each other, they create cycles of behavior that feel different each time. but follow the same structure. Fear, exit, relief, hesitation, euphoria, entry, validation, reinforcement, and then the cycle repeats, again and again and again. What makes this cycle so powerful is that it aligns perfectly with short-term market conditions. When things feel bad, prices are often lower. When things feel good, prices are often higher. So your emotional state naturally pushes you in the opposite direction of optimal behavior. Sell low, buy high, not because you don't know better, but because your perception is distorted at the moment of decision. And distortion doesn't feel like distortion, it feels like certainty. That's the trap. Because once you feel certain, you stop evaluating alternatives. You stop questioning your assumptions. You act, and then you justify. This is why awareness alone is not enough. Knowing that emotions influence decisions doesn't prevent them from doing so, because the influence happens before conscious thought, before analysis, before logic. By the time you are thinking, the decision is already moving in a direction, and your mind is catching up to explain it. This is why so many intelligent investors remain inconsistent. They understand the principles, they recognize the patterns, they can even describe them, but they still fall into them. Because recognition is not the same as interruption. To interrupt the pattern, you need something stronger than awareness. You need structure, something that operates independently of how you feel, something that does not adjust based on temporary perception, something that remains stable, even when you are not, because without structure, you default to interpretation, and interpretation is influenced by emotion, which brings you back to the same cycle. Different context, same behavior, same outcome. This is where the financial impact becomes even more significant, because now you're not just making inconsistent decisions, you're reinforcing them. Each time the cycle repeats, it strengthens the pattern. It makes it more automatic, more familiar, more difficult to detect, until eventually, it doesn't feel like a mistake at all. It feels like your process, your way of investing, your personal strategy. But it's not a strategy, it's a reaction loop. A loop that adapts to how you feel, instead of what actually produces growth. And as long as that loop remains intact, your results will continue to reflect it. Not your knowledge, not your intentions, your behavior. At some point, this becomes impossible to ignore, not in a single moment, not after one bad decision, but after years of small inconsistencies that never fully disappear. You start to notice something subtle. Your results don't reflect your effort. They don't reflect your knowledge. They don't even reflect your intentions, because intention is not what builds wealth. Behavior is. And behavior is only as stable as the system behind it. This is the part most people never fully confront. They think the solution is to improve their thinking, to learn more, to analyze better, to become more informed. But information does not stabilize behavior. It often does the opposite. It gives you more material to justify your decisions, more angles to interpret, more reasons to act, which means more opportunities for emotion to interfere. So the problem doesn't get solved, it gets refined, more sophisticated explanations, same underlying pattern. This is why someone can spend years learning about money and still repeat the same financial mistakes. Not because they didn't understand, but because understanding never replaced their decision process. And that leads to the most uncomfortable realization in this entire system. You don't invest with logic, you invest with emotion. And then you use logic to explain it. That's the mechanism, that's the pattern, that's the reason results feel inconsistent, even when your strategy seems correct, because your strategy exists on paper. But your behavior exists in real time. And real time is where emotion operates. Not in theory, not in long-term projections, in the moment, when something changes, when something feels uncertain, when something triggers a reaction. That's when decisions are made, and that's where most financial outcomes are determined, not by what you planned, but by how you responded. This is why the gap between intention and result can be so large, because intention assumes stability, but behavior is reactive, and reactive behavior cannot produce consistent outcomes, even in a system designed to reward consistency. So the real question is not, do you understand how investing works? The real question is, what actually controls your decisions when it matters? Because if the answer is your current feeling, your interpretation of the moment, your reaction to uncertainty, then the outcome is already defined, not immediately, but over time, through repetition, through accumulation, through the same pattern playing out in different forms. And that leads to a final shift in perspective, one that most people avoid because it removes the last external explanation. The problem is not the market. The problem is not the timing. The problem is not the lack of opportunity. The problem is the mechanism you use to decide. Because as long as that mechanism is driven by emotion, your results will continue to fluctuate with it, even if everything else remains constant, even if the system works, even if the strategy is sound. Your behavior will override it, quietly, consistently, over time. This is why the most important change is not informational, it's structural, not learning what to do, but removing the need to decide in moments of emotional pressure. Because every time you rely on decision-making in those moments, you reintroduce the same variable, emotion. And emotion does not aim for growth, it aims for relief. Relief from uncertainty, relief from doubt, relief from discomfort, but relief is short-term. And wealth is long-term. So every time you prioritize one, you compromise the other, not dramatically, not visibly, but repeatedly. And repetition is what defines financial outcomes, not isolated actions, not intentions, not knowledge, behavior, stable or unstable, aligned or reactive, consistent or interrupted. That is the real difference. That is what separates growth from stagnation. Not access, not intelligence, not effort, behavior. And once you see that clearly, everything else becomes easier to interpret. Because you stop asking, what should I do next? And you start asking, what is actually driving what I'm about to do? That question changes everything because it forces you to confront the mechanism before the decision is made, before the pattern repeats, before the result is affected. And in that moment, you finally see it, not as theory, not as an abstract idea, but as something real, something active, something present in every financial choice you make. You don't invest with logic. You invest with emotion. And until that changes, nothing else will.